Thank you so much for inviting me and for giving me the chance to speak here. It's a great privilege, and it's certainly hard to follow Alejandra's 2-hour presentation. So it goes to show the necessary ingredient and the grit necessary to be a value investor. But today I hope to discuss Azvalor's differentiated positioning within the value investor fraternity, and also perhaps provide some background on why value investing, as commonly defined, appears to have suffered so much. And crucially, what today's ills may portend for future returns for those mad enough to think that price doesn't equal value and risk does not equal volatility. Let's move on to the first slide. So the key messages that I wish to impart are summarized on this slide. Firstly, the duration versus size matrix augurs well for Azvalor. Regulation, cost, liquidity dissuade competition and create an effective moat. Close to heart, a London presence is accretive to all facets of the Azvalor investment process. The value investing family has been hurting with poor performance and dealing with a host of shocks and challenges, notably a shift to passive from active. And finally, record levels of price dispersion, extended and unsustainable valuations for growth stocks suggest inflection is close or afoot, which is promising. So I'd like to start by discussing my perceptions of our group from the vantage point of the London office as it compares to many other investment groups based in Europe's financial capital.
If you think he's speaking too quick, just raise your hands. I mean, Michael will try to slow down, but my experience is that it lasts 2 minutes. Then he gets to his normal pace. So if he sees hands, just raise your hand, he will slow down. If we do it 20 times, probably...
Okay. Well said. Thank you so much. So, what in my opinion makes Azvalor unique? So, for starters, Azvalor occupies an interesting and somewhat underpopulated niche within the value investing marketplace. It is unusual to see asset managers adopt a strict total asset target, as that is, of course, the feedstock for revenues and business growth. Further, Azvalor has invested in its own infrastructure to maintain and develop a strong rapport with its co-investors, or partners, as I prefer to call them. This includes bespoke events, such as this one, to allow stakeholders or interested parties to better understand the bonds that tie our firm together and understand what we consider to be core pillars. A well-curated and educated partner pool and regimented and proven process will deliver great results through a variety of different market and economic temperaments and cycles. So let's just unpack each of these separately. Firstly, starting with people. The strength of Azvalor resides in its people. There's an open door policy and a small scale of business which allow for free discussion and debate. I think everyone at the firm has the common denominator of natural curiosity and know that the mission is to scour for the most undervalued and esoteric opportunities around the world. So complexity and complex situations embed inevitable mispricings, particularly in a market that is characterized today by chasing fashionable trends in a valuation agnostic manner. If it's bombed out, trading at lowly valuations, then great. We believe that the risk is minimal as the price is low. Most industry participants today would ignore such securities given the high volatility readings, which they would equate with commensurately high risk. If it is unloved, well then that's even better. Again, today many market participants based in London and elsewhere would view out-of-index securities uninteresting and perhaps use an alibi such as devoid of a catalyst to pass. These sorts of embedded biases in the industry today, coupled with years of value underperformance, mark the utter indifference with which many other operators view what we consider to be prime opportunities. Therefore, our culture is one of searching for the best ideas and not let the usual litany of biases interfere with an honest and sober analysis based on today's valuation framed by fundamentals, which allow us to estimate the future earnings power instead of being fooled by today's perhaps lethargic earnings readings. And obviously on a very pragmatic level, our London office can host Madrid team members for conferences and conduct reverse roadshows as a course of this mission of ferreting out value. I would also have to highlight, and this is something that I note quite dearly, is the high level of operational investment, including the trading teams who focus tirelessly on ensuring that Azvalor remains utterly compliant, particularly in the light of ever-growing and burdensome regulatory realities. In a world where regulatory capital and compliance costs escalate higher than inflation, launching new firms is challenging, difficult, and thus establishing a boutique asset management business is akin to enjoying somewhat of a competitive moat. Lest we forget, modern regulation implies fines that could be business debilitating even for only one error. In summary, Azvalor maintains a very laudable operations report card, and investment in that pillar is sacrosanct, as no investment business can thrive without the best operations people. And from a London angle, it is likely that Brexit will not give us a pass in any way, and we will remain fully compliant with continued pan-European rules and regs. The second circle, process. There are no shortcuts in proper investing. Every idea at Azvalor passes through a series of filters to determine whether the idea warrants deployment of human capital, something that we're very precious about. Analysis performed using chiefly primary materials, including annual reports and those of the competitor set. Lateral thinking and working unusual angles in informational silos are highly encouraged. In an era where few investors bother to read financial statements, Azvalor's process is empirical and extremely regimented. And just to sort of showcase where we are today, GE's CFO reported in 2013 that its annual report was downloaded only 800 times, which is a remarkably low number. And there was a white paper put out by two academics, Loughran and McDonald, in 2018, who reported that the median US company today only sees its 10K or annual report downloaded 28 times the day of publication. So we're in a world right now where very few investors bother to read primary information and disclosure from companies, and that's a little bit of a competitive advantage for us. And just to sort of add on those two dates, 2013 and even in 2018, algorithmic trading, passive agents, and quants did not represent 80% of volumes as they do today. The recurring element here is do what others are not doing, and though it could be tedious, you have to operate with a check-the-box mentality in connection with every due diligence effort. Apart from financial literature, Azvalor also encourages meeting with informed parties, which include, of course, company management. And the London office sees significant management traffic. And given the House preference for out-of-favor and undervalued securities and industries, we may be one of only 2 or 3 solicitations that these management teams receive in the course of their London roadshows. These meetings are tremendously valuable, as offering support during periods of turmoil create a valuable opportunity to build bridges with these management teams. We are unsurprised that the market is willing to cast aside many fallen angel opportunities, and we're glad to be a conduit of liquidity in certain instances to help support these companies in their time of need, in exchange, of course, for healthy risk-adjusted returns. On a given week, analysts and portfolio managers may be traveling to mine sites, visiting jackups under construction in yards, or engaged on reverse roadshows to sound out ideas and perspectives with industry thought leaders. I can attest personally that at a recent metals and mining conference in London, for example, attendance was down by over 60% from the heady days in 2012, with many companies receiving no requests for one-on-one meetings. A recent rare earths metal conference I attended hosted key miners involved in development of cobalt and class 1 nickel for battery manufacturing, so effectively growth industries, and that conference was nearly canceled for complete lack of interest. So we are in the habit now of requesting the list of the least requested companies when we go to these conferences, on a view that these may be the companies with the most amount of hidden value and lack of recognition. Personally, I believe that it's an incredible time to be investing in these sorts of securities and building these bridges. And it's really a testament to how mad the issues regarding herding have become within the asset management industry, that such access is available even in the financial capital of the world, London. And last but not least, partners. Most importantly, the issue of quality and tenor of partner capital is something that's at the heart of how Azvalor has built its business. There is an element of self-selection bias, but it must be said that Beltran and his team's hard work has created and curated a pool of co-investors or partner capital which understand the chief tenets of value investing, which is that the convexity inherent in deep value underwriting may take years to properly emerge, with significant drawdowns as a necessary evil, and thus the value of long-term partner capital is really their commitment, not necessarily their investment size. The challenges and difficulties in finding this quality partner capital, which aligns duration of capital with duration of investment, bedevils many operators in the industry. There is simply no way that we could complete our mission of mining and taking advantage of obscurity and deep value without the support of these sorts of partners. And given the travails witnessed in London markets for peer value investors who put up gates and are under the focus of the regulator, the competitive environment is becoming even more favorable for us. So let's just examine this competitive field. The strategic focus on duration and not size is certainly at odds with the marketplace where size is often equated with success. Examining the current deployment of capital amidst a matrix of tenor versus size indicates that there's a sort of white space in the market for firms with our approach. In this slide, the circumference of circle is intended to indicate quantity of funds in competition. And there's a certain irony in the realities of declining liquidity within global markets since the global financial crisis, which have meant that liquidity-adjusted opportunity set has only been shrinking. And this would mean that a hard close approach to growth would make the most commercial sense to properly align manager and partner interest. This is really critical. And this is evidenced in Azvalor's near 100% active share. We don't have to shop in the index only and have much wider opportunity set at our disposal. Consider today that there are 3,150 non-ETF North American and Western European equities at a 5 million average daily value cutoff, but that drops by more than 50% to 1,460 at a 25 million average daily cutoff. So we often speak about skin in the game or proper alignment incentives in our portfolio company's ethos, and I'm proud to say that we are equally stringent in these criteria in how we manage our own business. So let's discuss and examine the liquidity bucket issues with a little bit more detail. These are gating agents. So this issue of declining market liquidity and commensurate shrinking of addressable market warrants more exploration, as it is often overlooked. The issue is particularly flagrant in Europe, which is a market close to home, where liquidity-adjusted market opportunity approaches a 5x differential for securities with above 50 million average daily traded value versus the United States. Many large U.S. investors have literal cutoff liquidity thresholds that allow investment in only 100 European issues versus a total non-ETF equity approach. And this is a shocking reality when considering Europe's aggregate GDP is greater than that of North America, let alone the US. So in plain English, this means that as the industry, this is the asset management industry, veers into passive structures, which can only invest in mega capitalization companies, and as surviving active managers who tend to be equally large and dismissive of less liquid securities, implies that the addressable market for Azvalor should therefore very much enrichen. And the absence or shrinking size of actively managed capital that can invest in less liquid or out-of-index situations is decreasing. And this means Azvalor can act as price setter instead of price taker in relation to its underwriting, and thus underwrite risks with better convexity and or capital protection. So how does this affect our office in London? Well, we receive solicitations for meetings with many of companies who are now, I jokingly call them excommunicated from the US due to these stringent liquidity bucketing issues. London's highly invested infrastructure, which includes 5 international airports and the Eurostar access to the continent, eases travel and catchment radius for business as well. And more specifically, and this is a contemporary issue, the closure of the North American capital markets to mining companies and some energy companies has created 12 relisting events in London this year alone, which is becoming the port of call for the space to access capital. And Azvalor can play a role in sponsoring redoms. Of course, we will only do that if the issuer gives us a big discount. And so this is a very tangible and good example of price setting in today's environment. Regulatory impact. So this slide is intended to show what's happened in the past decade. I mean, it's just getting worse and worse. We've seen a global step up in regulation, which is very pro-cyclical. It's very committee ordained and creates a host of unintended consequences. MiFID II, for example, has hurt independent research houses and increased research fees. This is, of course, taking place in the context of secular pressure on management fees, and this crimps manager operating margins. So, in mining parlance, the incentive price fees are now eating into variable cost and thus discouraging any supply response. This is not good news for new entrants in the asset management industry, but it is good news for established players like ourselves who can weather the storm. Regulation, alas, will continue, and Brexit, if it happens and when it happens, will not shield London-based managers from being affected by these decisions. I joke that a camel is a horse designed by a committee. As it pertains to post-global financial crisis regulation, I'm saddened to report that is absolutely the case. Of course, less startup activity for other asset managers means less capital, less liquidity available for smaller companies. And these deteriorating liquidity conditions mean less capital formation, less tolerance of risk, capital unavailability for those that most require it, versus a surfeit of mispriced capital for those that don't need it. So I think an effective way of describing today's environment is that fixed income-like securities are being bought for capital growth, and that's just an unusual situation. Again, it's not a great set of affairs, but not all bad news, because Azvalor's opportunity set is not beset by the same shackles that larger and more mainstream peers suffer from. And to put some numbers around it, in Europe, these unintended consequences of MiFID II have really created a very deleterious impact on company research. Both MiFID II and sell-side attrition has affected broker coverage of European securities, which have become therefore a natural place to discover and access value from London. The herding and momentum nature of European asset allocation, the sell-side driven nature of the region in terms of stock selection implies that there should be significant opportunity to create in-house earnings views for securities where the street has abandoned or has sparse coverage. And of course, the intuitive consequence is that less coverage securities mean more inefficiencies. More inefficiencies create more mispricings. Less estimates about a mean also typically go hand in hand with lower PE multiples as well. So while the environment is dire, it's not all bad news. There's lots to take advantage of, and there's lots that we're excited about. In terms of the London presence and how it fits in terms of the chessboard of the broader firm, London has great corporate access given its preeminence as a global financial center. And in addition to widely available primary information from companies themselves, London provides access to consultants, law firms, journalists, and other what I call silos of information that are influential and key ingredients in any part of an investment mosaic. On a given week, we may have 25 to 30 corporates roadshowing through the city. If a meeting is plush and management's unable to commit to a personal meeting with us, often breakfasts or dinners are available. We have relationships on a MiFID II basis with over 30 of the top brokerages, which allow for full compliant access. London, of course, has the English language, the global business speak, and its time zone allows for many conferences and other types of events. Such events that we have attended this year alone include the World Nuclear Association Conference, Rystad's seminal London-based energy conference, the 121 Mining and Metals conferences, the Mining Journals Conference, as well as an endless number of broker-sponsored conferences that include Nordic conferences based on energy and shipping, uranium conferences held by Canadian bulge brackets, and energy conferences, of course. So, having spoken a little bit about how we shape our business and how we think about mining an opportunity set, maybe it warrants speaking a little bit about what's happened to value investing over the past decade. It's been a really poor decade, frankly. There's been a tremendous outperformance of what the market considers to be growth securities versus value securities. Value investors have suffered. It's been a market which chronically refuses to re-rate securities that exhibit perceived subpar growth while over-rewarding those that do. And this has resulted in an incredible gap of performance and caused tremendous underperformance for managers who prefigure valuation as a critical variable in stock selection. And while it is true that earnings growth for these privileged few has outpaced those of lowly valued equities, the reality is that the outperformance has been governed by re-rating mostly, which is firmly ensconced in psychology and therefore ephemeral. The chief alibis for this include a presumption that low rates imply more value for longer duration growth stocks, or that so-called scarcity of growth implies a re-rating, and that's a canard that's been used during the depths of the 2009 crisis and for an entire decade to all-time highs today. But in our view, the culprit's more prosaic and related to the harrowing flow situation and negative feedback loops therein. This, of course, is the move towards passive investing and the false equivalence of volatility with risk that has been dominating conventional risk management thinking for over a decade. So this is a slide on passive active flows in USD billions. Passive migration, the boom in ETF issuance, and in smart beta products imply that growing swathes of the market discount or don't even consider securities which are small or securities which exhibit high realized volatility and those with large insider ownership, all of which are value stock hallmarks. Sanford Bernstein recently published an estimate that today there are 850,000 equity indices for a global market that only comprises of 45,000 equities. The entry of a categorically price-insensitive buying bid will inflate large market cap-weighted securities within an index and create a bubble in the large such that the bottom no longer matter. And this is aggrieved by central bank equity buying, for example, the Swiss National Bank or Norges Bank, which are now large holders in the mega cap companies globally. The SNB recently posted its latest filing, which shows that it currently owns over $100 billion of U.S. equities, and that is bought with utter price insensitivity. A similar situation with Norges Bank, which manages $270 billion within its latest filing. So post-Lehman risk management orthodoxy equates volatility with risk. And in my opinion, this folly creates a vicious spiral where low vol securities are bid up, further depressing volatility and thus further inflating their apparent allure. So financial repression has depressed rates significantly, which has re-rated bond proxies and derated more rate-sensitive equities, which are often deemed to be statistically cheap securities. Value investing requires patient capital, and there's a structural deficit for this type of capital as investor terms shrink and performance is judged in weekly terms and sometimes less. And again, there's an ever-shrinking focus on detailed bottoms-up research with forensic biases related to the accounting or examination of business models. As many of the actors that have done that in the past have had poor performance, and that's called into question their lifespan. All this are the unintended consequences of regulation, which deprive younger firms who can exploit some of the smaller issues from thriving, and are governed by these effective minimum capitalization hurdles and high compliance costs. So performance anxiety has thus caused a lot of value managers to throw in the towel and redefine their art. And finally, just a word about indexation itself. Both US and European indices suffer from enormous top heaviness. The top 20 names of a total universe of 643, for example, in the US constitute 30% of the total index by weighting. And that means that there's a commensurately unimportant but very long tail of securities. And today, the MSCI US index has a 30% plus weighting in technology alone, which is at a record level. The current market value of FANG-MAN, which is the 7 large tech companies in the US, is equal to $4.6 trillion. And the combined market value of every single listed company in Germany, France, and the UK is $9 trillion. So the 3 largest economies in Europe's market capitalization for all their equities is only double that of the 7 largest tech stocks in the United States. There's evidently a lot of value to be drawn out from the European theater, and having a London seat will offer a very prospective line of sight on that and give us an ability to extract that sort of value. And maybe a slide on the future. Well, valuation dispersion, which is a technique of considering how cheap is or how expensive is currently shown here. I stole this slide from Sanford Bernstein. So the rich are really, really rich, and the value securities are very, very undervalued. And these levels prelude an enormous value rally in 2000, where we had the last local peak. And frankly, we see history repeating itself. The absurdity of tech to constitute 32% of MSCI US weighting, with trillions of companies today trading above EV sales of 7x, nearly guarantees white-up losses for index investors. This will probably herald a golden period for active managers who can make it through a very difficult period of asset and people retention. So, to conclude, there's a generational opportunity in value investing for winners of attrition, like Azvalor, who have preferential capital. The past decade has been characterized by financial repression, central bank interference, and multiple expansion for a small coterie of securities, which has created a 2-tier or caste system market. Price is not value. Volatility is simply not risk. And rates are at record low level, value dispersion at a record high level, and this significantly increases the chance of positive value performance. And then, hopefully, the London office will help expand the reach and access of Azvalor to mine these incredible opportunities.
Muy bien, pues muchas gracias, Michael. Yo aprovecharía que, como lo ha leído, lo ha hecho un poco más rápido de lo habitual, pero yo creo que la gracia va a ser tener un poco más de tiempo para el Q&A. Tenemos 1 hora y 20, y yo aprovecharía para preguntarle las preguntas más variadas sobre macro, sobre micro, sobre compañías, sobre su personalidad, sus errores de inversión, en fin, todo lo que queráis, pero yo creo que va a ser más dinámico y más entretenido que a lo mejor esta parte, pues toda leída, tal, la presentación es extraordinaria, yo la leí, pero a lo mejor contada así muy rápido y con el ruido y tal, pues no es tan atractiva, pero yo sí que les animo a preguntar de todo. Y yo creo que Michael, justamente la gracia es que toca todos los campos y a lo mejor no da forzosamente las mismas respuestas que un inversor value normal, ¿no? O sea que adelante con las preguntas.
Any questions? Adelante, espera. Oh, sí. Mira, ya de la que pasas. Pásala esta.
Hello, I want to know how are you facing Brexit from the London office, and if you're taking any preventive measures in your portfolios. Thank you.
Yeah, no, it's a very good question. It's very topical given Boris Johnson's succession to Prime Minister this week. The truth is that no one really knows when and if it will happen. I've seen flowcharts from very storied economists that still have a higher probability of a no Brexit than a Brexit, despite all the news that we've seen in the forward motion in the filing of this process. There's an old adage that it's not really a stock market but a market of stocks, and we tend to have a very bottom-up approach and sort of sniper shot versus widespread approach to ferreting out opportunity. And so we'll consider Brexit and its effect perhaps on bear case scenarios for some domestic UK-linked securities, but we don't necessarily see it as a bad thing. Quite frankly, because of Brexit, a large of global investors have had a massive exodus from the UK markets. It's, per the Merrill Lynch survey I saw last month, it's the most underfavored region in the entire world. And this lack of recognition and lack of interest is usually the kind of music that we like to hear as value investors, because it means that there's very little price discovery. What's price discovery? It means that there's less people acting in the market, thus there's going to be a large imbalance in terms of price versus value. So, you know, despite Brexit being a very torturous event that could create a lot of economic risk for the country, you know, we actually see it as potentially a good thing to really extract value. And, you know, one good example of that is investment we've had in a lot of auto retailers, which have had, frankly, a torrid time, and they haven't been successful investments yet. We saw in July and June, we've seen record drawdowns in terms of auto registrations in the UK, so, you know, numbers that we haven't really seen since 2009. Of course, the securities have moved in lockstep with a lot of this negative news, such that today some of these auto dealerships have real estate value that is 25% north of their equity value. So in theory, some of those assets could be sold and then repurposed, and then that capital returned back to shareholders. But, you know, in the market's folly, they tend not to look at things in a very unlinear fashion like that, and they tend to overreact. So it's not something that I can definitely kind of predict. No one can, to be completely candid. But there's definitely going to be a positive impact in terms of opportunity set in the UK.
First of all, thank you for the presentation. My question is, I don't know if you believe that the UK macro evolution in the past has been aligned with the European evolution, but given if a hard Brexit happens, do you think that is going to be still the same?
It depends on what happens with the sterling, right? If the currency impact is going to probably be an enormous vehicle or a way for the economy to kind of refoot itself. If we see a precipitous drop in the currency exchange rate, then I guess the country could be more competitive, and that could engender somewhat of an investment renaissance. But that's going to take a lot of time. I don't really see the UK pivoting into some sort of industrial powerhouse anytime soon. In terms of just you know, where the UK remains strong, well, it's very innovative. It's easy to form businesses. It attracts a lot of, I would say, brain talent from the continent, because it tends to have more of a laissez-faire economy, and it's easier to kind of create business together with a lot of social costs. I don't think Britain's going to lose any of that heritage at all. So I think broadly we're probably going to see a continuation of the current mix of the economy in terms of its investment versus government versus net export take. But you know, if we see a massive change in calibration of exchange rates and interest rates, and then potentially we could see the embers of, you know, a new Britain emerge in the future. As I said in the presentation, I think one thing that's kind of interesting is that, you know, notwithstanding the turmoil and difficulty predicting when and if Brexit will happen, we have seen a little bit of a move in the financial center of gravity away from New York towards Britain, particularly for commodity companies. where capital move into, for example, in Canada, cannabis and crypto has meant that mining companies no longer have any port of call to go into Toronto. And so the inability for mining companies to get capital or gold companies to secure capital in Toronto means now they're forced to come to London. So again, an unintended consequence, and we can take advantage of that by giving them the liquidity, again, provided we get a big discount. You know, we've seen, this year alone, I've seen 10 different companies come and try to do that, and we actually almost came close to investing in one of those companies. But we actually were a little bit too stringent on price, and it went away from us.
And another question. This is more a personal question. Well, here in Spain, Azvalor and other funds are some kind differently viewed as others funds because they take into account the business cycle and the Austrian economic knowledge or view of the economy. I don't know, before joining Azvalor, what was your focus regarding the type of economic knowledge that you think is most, I don't know, right?
Well, as investors, yeah. Well, I've known Fernando for over a decade, well over a decade, and Alvaro quite well as well in the past couple of years. And I think that you know, the heritage that they really had from Bestinver is kind of transported and transmorphed into Azvalor. And I think that there's a common sort of a commonality in terms of process regarding underwriting risk at this firm that I recognize from my past incarnations. I think that there's a, you know, I use the word check the box mentality. It's a little bit like when you take off a plane, you got to do 40 things, and because, you know, those are 40 critical things, and if you don't do one, the plane could crash. And I think there's actually that's a similar analog to how investing is undertaken here. You know, the problem is that there's just a lot of time, and it's very tedious. You know, that's a specifically chosen word. I mean, it's very boring to read and go through the annals of company primary literature. Most people don't like to do it. In fact, so few people do it right now that there's white papers written about how so few people do it. So I think that's the common denominator. I see that there's kind of an echo of best practice that I recognize from some other halcyon firms in New York and London otherwise within Azvalor.
I guess one wonders if you have a North Star in terms of how to assess the economic cycle.
Gosh, I don't. I think you know,
Which is not bad, by the way.
I think you have to be very honest. You know, it's an incredibly dark art, and economists famously always have two hands, and they always hedge themselves. And there aren't that many millionaire economists for a reason. I think that the truth is that there's always going to be opportunity, and you know, some people say there's always a bull market somewhere. I think we like to think that there's always a bear market somewhere, because that's where we'll find a lot of opportunity. And so, you know, we drive towards explosions, car crashes, crises, because whenever things go pear-shaped and people are in a hurry to get out, you have a supply-demand imbalance that necessarily creates the key ingredient for proper value investing, which is a large gap between price and value. And there's always going to be those kinds of flashpoints around the world. The challenge is that when you go into those, you should know that even if you think that the price is X and it's at a low, you could still be quite wrong, and it could be 50% lower, and you may have to suffer a little bit of a hickey or a drawdown on the route towards, you know, a target price that you think is full and fair. Now, you may be of a mind and of a philosophical attitude that you can ride that risk and it doesn't really fluster you, but what's critical is your partners have to too. And that's really the secret sauce in what Azvalor is built, is having a really educated and well-curated partner pool who understand that volatility is not risk, and you don't necessarily make a lot of money in a straight line, but over time, value will out.
Sorry. So the previous speaker said that big investors, they tend to leave if they see something they don't like in the fund. Something happened, the market goes down. Do you have that experience as well, or do you have a different experience in terms of managing big investors? And how is your experience in that sense?
He means that the previous speaker said that institutional investors are easy to fly whenever they see something they don't like, and
Yeah.
he's asking if you think alike alongside. You know.
I think that's definitely true. I think, well, it depends on what kind of institutional investor you have. I mean, some investors are allocators of capital in that they are channeling or being an emissary for another owner of capital. And sometimes you have owner capital, which is the direct link to the capital itself, and they make the decision since there's no intermediary. You know, generally, good investors, I think, probably look for managers who have a great process and stick to it. And I think one of the greatest sins in investing is when you don't stick to the game plan, your orthodoxy of your process. If the thesis changes, then the security is lost. We have to exit it. And I think sometimes what I see a mistake that's often made is that you just fall in love with security, and that instead of actually exiting as you ought to, you change the narrative a little bit because it's easier that way. It's there's less of a moment where you have to sort of be a humble person and admit that you were wrong. And I think that's something that we're very good at, frankly, because we always make sure that the thesis is intact, and that's the primary question that flutters in our head and the first thing we think about in connection with re-underwriting a stock. I also think that we don't necessarily view a stock that's down 50% as necessarily a bad investment. It could be a great opportunity, and that runs contrary to the thinking of a lot of institutional investors these days that are forced sellers securities on the way down and forced buyers it on the way up. And so the way that they've structured their business, the architecture of their business, is poorly aligned with this idea of being a value investor.
Actually, your question is something we ask to Beltran every time, which is the profile of the institutional investors. And what he tells us after many years of meeting them is that there are just two profiles. There are the institutional investors that are at the helm of family offices, so they have skin in the game. And as Michael said, they find a manager whose process they like, and they tend to stick to it through highs and lows. But then there is another type of institutional investor, and probably a multiple bigger, who has no career risk, and is just the Amundis and these people invest in the latest hot fashion or trend, and the minute you are down, they leave, creating a liquidity problem. I am friend and a great admirer of Nicolas Walewski, for example, at Alken, and he had a rough patch, as we all do, by the way. And he went like from 8 billion to sort of 2.53 billion. Our friends at Sycomore, to whom we partners in the Synergy Fund, had likewise a huge movement. I don't recall if it was 06 or 07, but they had a big institutional base, and they got in a fund 50% of the assets out in a couple of weeks. So I think that was your question, and it really depends on who you have behind. We do not have the bad type of institutional clients because our commission structure deters them. They want kickbacks and rebates and what have you. What we do have is family offices that invest alongside us. We have all our monies in the funds, and we pay the same commission as our clients. And these guys, my experience with them is that they stick to highs and lows.
Yeah, there's a great investor that was asked the question one time, Boston-based value investor, one of the best ever, really. And he said, what do you consider to be a good investor? And he said, investors that add on drawdowns versus reducing on drawdowns. And secondly, investors who think I've had a good year when I feel like I've had a good year, which is a very wise thing to say, actually, when you think about it, because that means that there's a very, very deep and intuitive understanding of what drives this manager, and the investor knows that, and they know each other very well. And I think because we don't have any intermediaries and we have a direct rapport with a lot of our partners, we have that kind of communication is super, super helpful, because whenever there's any kind of panic in the market, they can call us directly, and we know them and they know us. And I think that distinguishes the firm a little bit. Now, the fill-up to that coin, of course, is that means of necessity we will not grow very quickly, but that's perfectly fine, because I think that the trade-off of high-quality capital that sticks around with you is far, far more important than the size of your firm. And as the slides show, the way the markets are constructed, the inequities of indexation, passive flows, all these things create wide mispricing gaps, particularly for smaller securities. And so not only is it the right way to build a business, but it just so happens the market opportunity actually speaks to that sort of construction as well, of being a relatively small firm.
Hi, I just have two questions. One is if you see value in the alternative investment market, and if the answer is yes, why there are not stocks of that market in the Azvalor portfolio? And the second question that I have is, what are your thoughts regarding Halma and Rightmove, and if you think that they will continue compounding in the future as they have done in the past?
So I'll take the second question first. We have a small investment in a company called OnTheMarket.com. Well, it's not even .com anymore. It's called On the Market, which is a competitor to Rightmove. You said Rightmove, yeah. And Rightmove. Currently, there's evidence that Rightmove is actually giving large discounts to retain their customers. There's been instances reported of 20% discounts, and I find that to be shocking because most sell-side analysts today have ARPU compounding all the way up from $30, which it was per month when the business first launched, to $1,000 on an average basis today, to $2,000 in 5 years. 2,000 from 1,000 in 5 years mathematically implies about a 16% compound growth rate. But we're already seeing that out of the gate, there's instances of discounting, very, very severe discounting. And so I'm actually very, very cautious about the Rightmove model. I think that they've been very usurious. I think they've been very unfriendly towards their customers, and somehow they lost sight of what really mattered, which is delivering value for their customers at a reasonable price. And I think that incipient competition from On the Market and other players, Zoopla, is creating a little bit of antagonist to them achieving those kinds of ARPUs. And at the same time, the price of the security is obviously, to my mind, extremely nosebleed, and so I would avoid it. Halma, I don't know very well, actually, to be completely honest. I probably ought to. The UK listed company, I hear good things about it, but I can't really opine more than that.
And the first question?
If you see value in the alternative investment market, and if yes, why there are no more stocks of that market in the Azvalor portfolio? Or
Alternative investments, you mean like private equity funds and
just
venture
because
capital
of
funds?
liquidity, markets.
You mean AIM, el mercado AIM?
AIM, yes, exactly.
Oh.
AIM.
Yeah, no, AIM is interesting. It's there's U.S. expression, trash and treasures. I think that the AIM market is helpful insofar that there's an earlier question when the gentleman asked about UK capital formation and what that may mean in an environment of Brexit. Well, the UK has AIM, which allows companies to get put together quite quickly. It doesn't have the same code of conduct as the primary listing LSE has. It doesn't have the same kind of requirements in terms of board meetings, corporate governance. And so it doesn't necessarily mean that the companies are frauds or hoaxes. You have to sort of invest with your eyes wide open. I've had mixed success in the AIM, just like everyone else. I don't think we have any specific approach, though, in terms of looking at AIM versus LSE as a driver of where we're going to marshal our human capital. If a company graduates from AIM to the LSE, which happens quite often, great. And then at that point, you'll have a little bit more of an investment cohorts that can look at the security, because some houses don't even look at AIM on principle. So yeah, I think it's something that we're conscious of, but it doesn't necessarily inform any part of our investment process. I do hope, though, that AIM or AIM-like in exchanges are opened more in the continent as well. I think that would be very helpful for business formation here and therefore employment and economic growth.
And then there is another interesting point, which is that we should be very careful about return on research. We are a team of 7-8 people at different times, and we have 10 hours per day of installed capacity. At the end of the day, it's the same amount of effort and energy to analyze a 40 million market cap than I wouldn't say a 40 billion, but maybe a 2 or 3 billion, which would be our sweet spot. So if we would go too much into these small names, I would worry from outside because we are killing return on research unless these small companies are a natural extension of some of our fields in which we already know, the who is who.
Yeah, and I think it's just important to know, on that note, I think it's important to note that different people have different definitions of what constitutes small. The slide earlier showed that the liquidity cutoff for X million dollars of average daily value means that U.S. investors will only have a de minimis amount of opportunity. I think we're talking about some houses in the United States today require their analysts to only look at securities that trade over $50 million a day. Well, guess what? In Europe, there's only 100 such securities, and that's really what I find to be incredible. Is sort of like it's very hard. I would find it. Maybe some investors are who are better than me can do it, but I would find it very difficult to find variant perception, unusual angles, identifying embedded call options for free within a company like Nestle that is, basically analyzed by 60 people and is a great company. And then people, you go to conferences these days where investors describe an investment thesis, and we tend to think of investment thesis as Street thinks this, we think this, and this is why. That's simple. But often investment theses these today at many conferences I hear is just a guy saying what a great company it is over and over and over again, and they use that horrible word compounder, which drives me nuts.
In the previous conference, we asked regarding the biggest company in the AIM market, Port for Capital. that could be listed in the LSE market. That's the reason that maybe there are some kind of hidden gems in these kind of alternative markets. That's
sure. And we have some in the non-public portfolios.
Yeah, definitely. Yeah, we're not like racist or prejudiced about whether or not it's an AM security or LSE security. It's more about the context. Opportunity is always going to be, it's going to be high volume. There's this word that we use all the time internally, which is forced selling. And no matter where I am, I could be sleeping. If you say forced selling, I'm going to wake up because that's what gets me the most excited. And whenever there's a forced selling situation, the intuition is quite simple. When people are panicking, they make really bad decisions. Really bad decisions create opportunity. Why? Because they sell at really bad prices for them, but great prices for us. Great prices are the father of great returns. Full stop. And if you overpay for a security, you're totally screwed.
Alvaro, would you mind to explain more regarding the private portfolio? Because at least I was not aware that there was a private portfolio in.
Yo no sé, no sé.
If you would mind to explain the private portfolio, because I was not aware, at least, that at Azvalor there were some kind of.
There is the Ultra Fund. That is, it's a Luxembourg fund, and now the Spanish version comes in. I actually should know when, but we don't care too much about commercialization because I don't know actually when this product is gonna be for sale. But I think it's in September. The files and everything is done, so it's gonna be like our hedge fund in our previous life, let's say.
But it will be in the Luxembourg SICAV or?
No. There is now a Luxembourg SICAV that's up and running for a year or so, but the minimum ticket was 10 million. And now we have a ticket, CNMV, regular product, with it's a Fondo de Inversión Libre, un FIL. It's going to be out there in September, and the minimum ticket is going to be 100,000. I'm not sure, actually, I should know, but that's a question for Beltran. But.
And you will begin to market, to put marketing campaign or something, some information in the website, or not
there is no marketing campaign at Azvalor. Have you seen one?
No.
Ever?
I'm talking that Valor website.
Yeah, sure. I mean,
Okay.
Sure.
Okay, thanks.
Okay, thanks for your time today. One question from my side. Could you discuss any value trap stock that you have experienced through your investment career? What you missed your initial analysis and what you learned from that? Thank you.
Oh gosh, I think like a lot of value investors, unfortunately, my career has been plagued with many of them. They're inevitable. You're always going to see them. I don't know. In a prior life, I invested in. Let me think of a good example. Or a good example could be Marie Brizal. There was a situation called Marie Brizal in France, where this is a company. Just taking a step back, I think that in the United States, situations that undergo a bankruptcy or a reorganization have a federal really level statutes, Chapter 11, Chapter 7, and these chapters are legal processes these companies undertake. And no matter where the company is, of course, there's some statutory differences from state to state, but broadly, the playbook is the same. And so when you invest in the debt, you convert to equity, you know what you're getting, and the company emerges. And in Europe, there's no such thing as Chapter 11, at least not on a pan-European basis. So every single country has its own code of conduct regarding reorganizations. And the reason I find this really interesting and it strikes me is because this concept of forced selling. There was I'm going to answer your question in a roundabout way, but there is a strategist at Morgan Stanley I had lunch with about a year ago, and he said that he had a dinner with a Danish pension fund manager who opined that even if a bond was trading below recovery and the company was going to file for bankruptcy, he would rather sell it. And the guy said, why? I said, because to me, my track record of not owning any companies that go bankrupt is more important than making money, as he put it. Now, I would say that a better description of that would be fiduciary irresponsibility, and that's something that he should probably have a conversation with his superiors. But I think this goes to show kind of the mentality in Europe a little bit and how it distinguishes a little bit from the United States, is that you have a situation where workout is a 4-letter word. If a company's undergoing a workout process, I'm going to get the hell out of there because I don't know what's going to happen. There's no regimented process. And if it's in a foreign jurisdiction, well, then I need to learn how to speak French, and I need to hire French lawyers. It's expensive, it's cumbersome, it's painful, and my investors are going to ask me questions about it. I don't want to deal with that. And so this creates an inexorable selling situation, and that will climax in a massive gap between price and value, particularly if on the other side you equitize yourself into actually a very favorable situation because the company's reduced its debt, it's diluted the hell out of its shareholders, there's no broker coverage, and it's going to emerge with a clean balance sheet potentially, or at least a balance sheet which gives it some lifespan, and from that you can actually generate a pretty healthy return or arc. And these situations, I guess a little bit like games, sometimes they actually culminate in really great outcomes, and sometimes they go right back into bankruptcy. And the situation that Alvaro and I were talking about was Mali-Bliza, which was a company that was once called Belvedere and it changed its name, and it had basically a lot of fraudulent accounting. The company went into bankruptcy, and the creditors were turned into shareholders. And it emerged, and what we saw at the time was a situation where you had a company with a lot of brand value, hiring someone who appeared to be a very credible manager to bring this together, hopefully obtain some margin upside. I mean, this is a branded spirits business distiller that was trading with negative EBIT margins, which is kind of incredible. And the brand value itself, in our estimation, based on interbrand value, was worth more than the enterprise value. So there was several ways you could win, apparently. Now, the reason it ended up being a little bit of a value trap is that the manager who was brought on board was quite commercial and a little bit too much of a salesperson, and he basically overpromised and vastly underdelivered. And at the same time, I think there were some more existential issues in terms of the actual machinery of their business, which disallowed them to recover those margins in a time period that investors would have wanted. So that company emerged, I think, from memory, maybe €4, and then went up to 18 at its peak, then to 12, and then currently trades around €2. And so it was unfortunate. It wasn't the outcome that I expected, quite frankly. So lesson learned.
Actually, I'm not sure if you were asking Michael for current value traps or former ones. Maybe a former one in your former life before joining Azvalor.
Well, that was one.
Marie Brizard too.
Yeah.
Yeah.
Fortunately.
Yeah. Currently, I don't know. I don't know if you have a view on De La Rue. De La Rue is a company that we know for a long time. The stock has collapsed massively, and they do banknote printing, and they have also a service business. I'm not in a position to say if it's a value trap or not, but I don't know if you have a view on that one.
Yeah, no, it's a business that has historically been linked to printing banknotes. They've got a sort of young and high-growing traceability business as well. There's some substantial IP in the business, but it's obviously just like a lot of companies that are facing these trends of dematerialization and more e-commerce and financial transactions, and fintech is getting better, and it's propagating to situations where. I saw this morning on CNBC they talked about how some mints around the world are no longer even producing coins, for example. So that's going to be something that's going to affect their volumes and their utilization rates, and they're going to go into loss. But there is a price for everything. I mean, most recently the company's been savaged with a SFO investigation in association with bribery in South Sudan. So if things were bad, they got really worse in the past week or so, and that's created another leg down in the share price. So we could take a look at it, but heretofore it's been a little bit of a value trap, yeah.
Hey, Michael. Thank you very much for taking the time to come from London to El Escorial and give us a really good presentation that has definitely helped us. And secondly, I will just want to ask you a generic question about your past experience in investing in companies so we can learn about it. So what were your biggest mistakes? What were the reasons behind them, and what did you learn from them?
Gosh, I've made many mistakes. I think prior to joining Azvalor, I ran a small hedge fund, and we launched with about $80 million of capital, and that the high water mark on that was about $120 million. And unfortunately, we had a poor performance, and the poor performance caused our main partner to redeem their investment in the fund. And it's a mistake in the sense that, of course, I wish the performance would have been better, and I wish I could have delivered for them. But at the same time, perhaps I wasn't as attuned to them as I had been effectively. And this kind of speaks to my earlier point about know thine self, but also know thine investor pool, and understand their own how they define risk and what they perceive to be risk, and understand that they should really know what you're doing and be well aware that there's going to be a lot of volatility in your practice. And so if you misalign your business with a pool of capital, you have an inherent, the chief sin in any business is asset liability mismatch. And this is exactly the same thing. You have an asset liability mismatch in terms of the risk tolerance and risk preference and utility curve of your investor pool versus what you're actually doing. So that was obviously a mistake on my part, potentially.
Hi, Michael. Good morning. First of all, thanks a lot for your presentation. It has been great. Just to complement the previous question, could you please have a quick explanation about your best investment choices during your whole career, or at least in the latest 10 years? Thanks.
My best one, wow.
I don't know. I know my best one.
I believe you have had 100 of investment, really good investment opportunities, but I don't know. Maybe you have a top 3 of your favorite ones. I don't know, the more profitable ones.
I remember one that happened very, very early in my career. This is one of the first ones I ever did. Was a short investment, actually, not a long investment. So I'll talk about that one because those tend to be more fun anyway. But there was a company called Circuit City in the United States.
Yeah, I know that.
And they had a business where it's just a conventional electronics box.
Circuit City was a competitor to Best Buy,
It was
right?
a competitor to Best Buy. It'd be a competitor to Darty in a European context or Carphone Warehouse. And the thing that investors missed about this company, and when I was an investment banker, I focused on credit cards and commercial finance. And by the way, I focused on those industries because all the analysts at the time wanted to join the tech and telecom teams, which meant that there was absolutely no interest in financial services. And I think that was probably the first contrary decision I made in my career. But in the course of working in the credit card investment banking landscape, I discovered that there's a lot of primary disclosure surrounding credit card companies, monolines like at the time MBNA or Capital One, but also stores that gave their customers credit cards. And Circuit City was one of those stores. So Circuit City had problems in growing their electronics retailing business, and as a further vector to their growth, decided that they wanted to become a credit card company. Now, the thing about credit card companies is that it's a really tough business because the DNA of credit card companies is 7 or 8 PhDs who are incredible computer scientists and statistical engineers that sit inside a dark room somewhere in Virginia and come up with algorithms. And Circuit City had no business kind of pivoting into this part of the world because they had no expertise. And they did it really just to achieve EPS goals because that's where their incentives were built, as many US companies have in terms of growth at the time. And so they gave a lot of credit cards to customers, and they suffered from adverse selection, which is a fancy way of saying that the credit card recipients were those who were unable to get credit cards from traditional channels because they were such poor credits. But the guys at Circuit City didn't understand this. They just wanted to grow, and they were probably incentivized and compensated on growth at all costs, above all else. And so they started distributing these credit cards, and these credit cards were credit cards that they could use at not only at Circuit City. It wasn't just private label. It was branded credit cards they could use anywhere. And so of course, the people that got these cards felt like they were blessed because they couldn't get them anywhere else. They drew large balances, and of course, when the economy just deteriorated a tiny little bit, there's a lot of torque in these businesses. 2 percentage points up in unemployment could mean a 30-40% spike in NPLs. So the interesting thing about this one was that the credit card business was not a separate line item in the business segment disclosure of the 10K. The net income from their credit card business was booked as a contra revenue line to their SG&A, which is
Explain it more slowly.
So effectively, so if they had $100 in revenues and they had $50 in SG&A, really they had $70 in SG&A, but they had in cost, but they had $20 million in net income, and they would net it out and just show minus 50. So they were, pardon my French, I grew up in France. They were bullshitting you. And so because this was never disclosed properly, it was masked. It was very, very hard to divine what the true profitability of the company was. Now the thing is that because the credit card business is a regulated business, banks in the United States still have to put out these monthly reports. And so you could get the monthly reports on the credit cards by vintage and look at their loss rates, what was happening in terms of the bucketing, 30, 60, 90-day default rates. And you could clearly see that the future was very ominous for these Circuit City credit card cohorts based on these ABS filings they had to do. But no one who owned Circuit City, they were all retail portfolio managers. No one was a credit card or financial services portfolio manager. And even if they were, they'd have challenges in knowing where to look to get these call reports, as they were called. I had just worked in the credit card business as an investment maker. I knew where they were, and this public, completely legal, unprivileged information is just, you got to know where to look. And you could clearly see that there was a car crash happening, and it was basically born out of this business pivot, a year prior to sort of start issuing credit cards. What I did not know, and the reason I put on the short was that no one seemed to care about this or look at this at all. And then finally, when the chickens came home to roost.
At what price did you short it?
Oh God, I can't remember.
It was like high 20s and it went to zero basically.
We didn't short it all the way to zero. We just shorted it for we actually took profits because the company had a massive profit warning, and they missed, and they said it's because of the credit card business. And I remember on the call, all these guys covered Circuit City professionally, and like nobody knew that the credit card business was booked as a contra line item to their SG&A. So, I remember Barry Stearns had the best analyst, and she put out a report the next day, and the title of the report was "Circuit City's a credit card company. Who knew?" But that was a funny one. That was stock was down 40%.
More questions. A ver.
Thank you for your presentation. The access to financial products by young people isn't very easy, and Azvalor launched some months ago the opportunity for young people to invest a minimum of 500 euros. From your view, what's the situation in the UK? Because the financial culture there is much more spread than in Spain. Do the funds offer this kind of opportunities to young people, or must they go to the commercial banks where the products are mostly rubbish?
I think the UK has a culture of independent financial consultants that give financial advice, but I think that they probably target a little bit of an older demographic than the young people. The UK, like a lot of European countries, has special tax deferred packages that you can use to take out pre-taxed income, and then so it gets taxed upon retirement at the age of 65 and compound on a preferential basis. So there's the types of schemes that you might find. The U.S. has the Roth IRA, for example, and this is sort of an analog system to that. And then separately, it's not necessarily equity investment, but the UK has recently enacted a program called Help to Buy, where the government will basically guarantee your rate on a mortgage product, and also in some instances help you with the down payment on a view to. I think probably the correct view that home ownership leads to more wealth accumulation, and it means that there's less of a burden on the financial teat of the country. So they have different schemes in place that kind of resemble what you might have here. But specifically, I'm not sure about whether or not there's any specific program on a ticket size basis, which cuts off and allows citizens less than 18 or whatever to have preferential access to that. I don't know.
Hello, Michael. Good morning. Thank you for the presentation and your time. Now, looking forward to summer, could you recommend us some books that you think are essential?
Gosh, well, I just read the biography of J.P. Morgan, and that was fantastic. That was Ron Chernow's book. It's old. It's been around for 20 years, I think, but it's just an absolute masterpiece. And I read it because he did a similar one on Rockefeller, and I found that to be really, really interesting stuff. And another book I read was the biography of Ozzy Osbourne, which is really funny, and I recommend Ozzy Osbourne, the singer. Alvaro has not read that book yet. I'm going to give you a copy, but it was fantastic as well. So those are two that I read over the summer, but I need to probably finish that up a little bit and find some more financial ones. Another book that's the next on the reading list was given to me by I mentioned earlier how we try to build bridges with a lot of these CEOs. Well, we're obviously very commodity focused right now, and a lot of these guys are non-believers in global warming. So I have a book that debunks global warming that I've been advised to read by the CEO of Africa Energy. So that's also going to be something that I'm going to do pretty soon.
Good morning, Michael. Could you please tell us the main 3 goals of your life?
Gosh, that's extremely philosophical question. I'm a father of 3, and I hope that my kids grow up to be very good, honest people, and I hope that they're very happy. So if I'm able to do that, I think that would be one arrow in the quiver. separately, a little bit more close to home and probably in tune with this conference, I hope to be, the part of building this great firm out a little bit and helping in London. Hope that we can successfully drive returns and deliver for our investors in a manner in which we promise and we stick true to our knitting. And finally, I think, I would just, hopefully be able to retire at some point in the distant future and spend more time with my wonderful wife and catch up on a lot of reading that I ought to have been doing for many, many years, I guess.
Hello. Hi, thank you for the presentation. Maybe it's a strange question, but do you have any opinion about the current semiconductor business cycle? Because some companies look quite optically cheap. Like, well, I have in my mind Micron technology and that kind of stuff. What do you think?
Can you do this one?
I do have one, but go ahead. The question is for you.
I'm afraid I don't know that area very well, and I think anything I would say would be there's an expression in the U.S. which is, just enough to be dangerous, and I think I know just enough to be dangerous about semiconductors.
Well, that's basically it. I mean, you notice that be it Texas Instruments, Micron, Samsung, any way you look at them, they are a proxy into the mobiles and the computer and the cars, elements of our daily lives. And if you look at, there is an industry, the Semiconductor Industry Association, that publishes pretty reliable data. And one can see that pretty much as in 06 that you are here, and when you are here and it's a fixed cost business, you look cheap by definition. So you look cheap on PEs, but the minute sales fall 25%, some of these companies lose money. So I tend to follow a guy called Fred Hickey who's been 40 years into the semiconductor business and has an eye for value and is pretty Austrian too. And he looks pretty negative now. So for us, I mean, the reason I follow this is because Samsung is a company that we like and that we've owned in the past. We sold it in this new Azvalor sailing after an 80% return, but it remains very cheap. It remains at maybe 3 times, 4 times earnings. If you buy it through the preferred shirt, it's a bit less liquid. But once you adjust for the semiconductor eventual cyclical downturn, you are at 12, 13, which is pretty much fair value, right? So I would be cautious.
Hello. First of all, thank you for your time. And I would like to ask you. I would like to ask you to give a sort of like a quick description of what the city is like. What's the city? I mean, like the financial environment there. How does it look like? And some guidelines for foreigners, such as we drive on the right side. We drive on the right side of the street here. Don't do that. And sort of, what kind of differences or what advice would you give to foreigners over there?
To live as it pertains to the United Kingdom, or
yeah.
I think it's interesting. There's London is a little bit of an expat city, so of course it's part of the UK, but I think you might find that there's 60 languages spoken, and I think over 100 different nationalities in the city. It's extremely cosmopolitan. It's extremely mixed, very heterogeneous. The financial services space there is as I said, despite Brexit, it continues to grow. It's become a little bit of a financial hub, and some would argue that it's eclipsed New York in some verticals. I would say probably all of them, bar technology at this point. I think as advice, it's if you're interested in career in financial services in the UK, I think it always pays to conduct internships, get to know people, network a little bit. Understand that different firms have different ethoses and different ways that they work their business and invest, perhaps. And not all of them are. There's no good or bad in this business. There's perfectly talented managers that ride the wave of momentum, and they're able to actually deliver healthy risk-adjusted returns to their investors because they're good at what they do. And some investors don't even open annual reports at all because it's just absolutely not part of their process. And London has all those types of different investors. I think if my own experience was doing a couple of internships in college, becoming an investment banker, which is a little bit of Herculean task given the hours that are required and the amount of modeling. But in a sense, you cut your teeth. You develop a little bit of knowledge about accounting, finance, and responsibility, and then you can kind of take that with you, and it'll follow you through your career. I would say just on a university level, I think the toolkits that would be helpful in the UK and otherwise is just a tendency to gravitate towards problem solving and complexity, and not being afraid of challenges, and also, again, I've used this word many times, but just being extremely meticulous and aware that there's a lot of tedious requirements in this business as well.
A ver, lo que esté más cerca del micrófono, así vamos pasando y ganamos tiempo.
Thank you. I'd like to know your opinion about how the emergence of new financial centers like Shenzhen in China, for example, can affect London and other traditional hubs.
Oh gosh, yeah. I mean, for sure. The populations, the demographics, the demographics and populations in those parts of the world probably almost guarantee that'll happen. I'm just not sure it'll happen in this room's generation or our scope that matters here. This is probably something extremely more long-term ordained. I think the London and New York have been hubs, and I think there's network effects that they benefit from. The reality is that English, as far as I know, is kind of here to stay for the foreseeable future in terms of the natural business language, and that's helpful, given London and given the Anglo-Saxon temperament and relevance it plays to financial services today. But I think it'd be loath or naive not to assume that at some point Asia's going to catch up and be very, very critical. So I don't, Asia's alas a little bit of a white spot in my own experience and career. I don't know it as well as I ought to. I think that there's similar issues related to the indexation madness, the folly of crowds, passivization, which Japan is 70% passive, so it's much higher than and we've seen, like we see here, we see kind of a two-tier market in terms of the price to book of the have and the price to book of the have-nots. And so my hunch is that there's probably a lot of non-index, esoteric, unusual animals that could warrant attention at some point. So it's something that we should think about. And we recently hired someone actually who's got some affinity and some knowledge of Asia, and I think he could be a useful emissary to sort of go and ferret out value, because that's something that I don't think correct me if I'm wrong, but it's not an area of focus regionally that we've had necessarily.
Thanks for your time here with us. As it was already said, London is a major hub for the financial services, and as a consequence, it became a major hub for the fintech industry also. What I would like to know is what is your personal opinion about how the development of digital banks like N26, BNext, Revolut, and many others will affect the traditional banking industry, and how the rise of paying apps and transfer apps like Bison, TransferWise, and will affect also this industry, and how are you guys dealing with that in terms of investment?
Well, we have many of the companies you cite are pre-public, so they're still kind of their infancy stage. They're backed by venture capital funding or angel investor funding. But I guess the life cycle of many of these companies is kind of shrinking a little bit. You're finding that companies are IPOing earlier than they did in the past, and the market's accepting these, the cloud companies and some of the fintech names you cited. I think that those, like a Revolut is an interesting example actually, because that's been in the papers because of concerns about money laundering, concerns about KYC, know your client. And so, even though that they provide a role and a very valuable service, at the same time they're growing very quickly, and they have to be careful not to grow too quickly. I think that these are challenger businesses that will definitely disrupt the traditional banks. As a house, we don't necessarily eschew banks completely, meaning don't look at, but we don't necessarily feel like we have enough of a strong view or a variant view to warrant and channel human capital towards those parts of the market.
Yeah, one of our analysts, Javier Duna, has been a consultant to the payment industry and has cut its teeth there. And we looked at data, and I mean, we've looked at some, but there are, because they are the disruptor, they came to the market at a price that discounts a lot, and I personally don't know if I can know better than the market about the growth rate 3 years from now. It's what we were talking yesterday. I mean, when a stock is dear, you maybe have a bit more earnings growth, but definitely not the multiple expansion part. And I'm sure there are going to be opportunities there, but we are not maybe the best to grab them now. On the side of the, let's say, the disruptor, on the side of the disruptee, we think the banks are going to be seriously challenged. I mean, they have legacy assets, legacy IT systems, more people than they really need, more square meters than they really need. So, you know, systems that don't compulsory talk between each other in the way that they should be talking to each other. I mean, technical systems. So, you know, they are left with insurance, which is also being disrupted, with funds, which is also being disrupted. And so I wonder, you know, how they will make the money.
I also say that obviously central bank policy has been very, very hurtful for their business models because they tend to be asset sensitive. They tend to perform better when rates normalize, and we've seen quite the opposite happening. You know, I think the Greek yields went lower than that of the U.S. for equal tenor this week, which is incredible considering that Greek yields were 30%, 2012.
Yeah.
So I mean, it's just shocking kinds of moves in terms of not only the shape of the curve but also absolute levels, and that portend very poorly for bank net interest margins.
But they got into a labyrinth, which has very difficult exit. I mean, all the private debt, as Jose Ignacio explained, has become in a way public debt. So, you know, my business needs higher rates. Yeah, but if you have higher rates, you have to market your bond portfolio.
I would, just as an observation about technology stocks, I know it's a little bit of a topic because we don't really, our absence is sort of conspicuous. And as I said in the presentation, currently the MSCI weighting for technology is 30%. And by the way, that was, so the MSCI changed the way that they report Facebook and Google. So those are no longer in technology, they're in communication services, but I think that's kind of not, you know, again, bullshit. So I'm just including it and describing it the way it is, not the way they try to pretend it is. But the truth is, when you have 30% weighting of technology within a regional index, obviously it's going to have a lot of importance, and there's going to be a lot of human capital dedicated to it. But you know, when Uber had a roadshow in London, they hired one of the fanciest hotels, and it was standing room only. And in fact, to even go, you had to get a special badge, and it was all extremely regimented and almost like, you know, a state affair. And I find that those kinds of events, to me, in my experience, are an absolute turnoff and not something that's worth spending any time on. And if you take the flip of that coin, then you look at some conferences we go to. There's a conference I went to recently, the 121 conference, where there were fewer attendees and there were CEOs. So that's how out of favor and unloved the space is. And to me, that resonates to me. So, you know, we just, it's not to say that the crowd will be wrong, certainly will be right, but I think our investment process is built out of variant perception that's backed up by primary research that's defensible, right? And so it's just intuitively, it's very hard for me to be the 101st person at a big lunch in London where everyone's going ooh and ah and trying to basically, you know, be chummy with the bankers to get a very hot allocation that you can flip. Great, some people are good at that. That's simply not what we do. And I think a better use of time is actually going to securities that are completely out of favor, because this is the time that you develop relationships and build bridges with those industries, because this, you know, this too shall pass, and there's going to be a point in time where gold and uranium are going to be the darlings, and at that point we'll probably exit, and maybe technology at that time will be interesting. So we're very decidedly contrarian and counter-cyclical in how we marshal our horses and look at opportunity. And just you know, as a side note, I've invested through several cycles right now, and you know, of course, technology at 30%, it kind of feels like this is going to grow to 40, 50%. That's what the bulls would say in terms of their prognosis. But I'm old enough to remember when Apple was almost a statistical net. There was almost more cash than market cap in March of 2003. And you know, famously, Michael Dell sent Steve Jobs an email saying that you should probably just liquidate the company and hand back cash to your shareholders. This is not made up. This happened. So you know, there's episodic moments of folly that become moments of extreme pessimism, and that's the time to get involved, I think, and to actually dedicate a lot of resources to it. So you know, ask yourself, what is Apple in 2003 today? What is that? And that's sort of what we're always talking about internally. That'd be sort of the holy grail. As it turns out, you know, there's a whole separate conversation about what passive investing has done in terms of creating, you know, sort of a higher valuation levels and systemic problems in finding absolute value. But we can still find it on a sniper shot level. And you know, I still think that some of the situations that we're looking at today and studying very thoroughly involving commodities and energy are, to me, absolutely fascinating. And the complete utter indifference from most investors about these spaces make me that much more bullish about it. But it's okay to be lonely, and it's okay to march, you know, to your own drum music, you know.
Hay más preguntas, estamos ya un poquito en el límite.
Sorry, I just want to know what's your view about funds managed with algorithm?
I think the problem I have with algorithmic and quantitative investing is that I think a lot of their core principles are stem from this idea that risk equals volatility, and so you'll find that a lot of companies, we're invested in a driller, for example, in Norway, where all of a sudden on the registry, because of short disclosure requirements, there were 6 quant funds that had been shorting the security, and the reason that they were shorting allegedly is because the machines had told them that it was a good short because the stock price was going down, and so it was going down, and that created more machines to sell it short, and went down more, and that attracted more short sellers. And so to me, there's just an incredible amount of circularity and tomfoolery going on in a lot of these algorithms. And the problem is that there's just few guys on the other side of that, because the natural person to take the other side of that trade would be an active manager, and many active management companies are losing their assets, and they're just more worried about doing what they think critical, what they think their clients would like them to do, not necessarily what they themselves want to do or what the right thing is to do. And they have to do that because they haven't necessarily engineered their business appropriately. And as we've said, this all roads lead to Rome. This is inevitably going to be to do with the quality of your investor pool and understanding or having people that understand what you are doing.
Thank you very much, Michael, again. I wanted to know first, if a country has good fundamentals for growth, low indebtedness, population growth, respect for institutions, what are the key issues you might look to see whether the growth in the country will be translated into the growth of the earnings of the companies? And then, given the current situation of Venezuela, in which defaulted bonds are trading at 15% of face value, would you invest in these bonds?
Yes.
Maybe you cannot, but would you invest in the sense that do you see an opportunity?
So the first part of the question, you're absolutely right. So on the base side, mathematical identity is GDP growth is population growth plus productivity growth, and that's just a truism. And so there's going to be situations where you can have a backdrop where both are very, very good and favorable, but at the same time, the equity market may be a total war zone because the valuations are poor, because of bad corporate governance, poor accounting, a whole litany of different reasons. And so, I think we just completely divorce the macro, if you will, and our attitude about stock selection is very much best athlete. We try to find the guys and stars that'll win, irrespective of what the country's context GDP is doing. In terms of distressed debt at the sovereign level, I mean, I've looked at distressed debt in prior lives, and I actually think it's a really interesting place to look at right now. There's some slides I actually didn't include. I was thinking about including them, but one of them that was interesting was the lack of bond inventory right now at bank levels because of the pro-cyclicality of regulation. For 10 years now, there's fewer and fewer owners of these actual bonds, but at the same time, there's more and more ETFs and indices that own bonds, but they don't really own them. They own them sort of synthetically, almost maybe through CDS. And so you have this massive mismatch between the actual liquidity in the bond market and the number of bond instruments out there. And I think you're looking at a little bit of a car crash or accident waiting to happen in connection with all these new instruments. So when we have kind of a liquidity crisis, I think it's inevitable at some point. There's going to be incredible dislocations in the corporate bond space. And you'll find that underwriting recently for distressed debt has been very lax. If you look, for example, at credit spreads versus rating, in 2009 when everyone was panicking, the triple C's were unable to borrow at any cost, and now triple C's borrow basically the same level of double B's because there's a thirst for yield and negative yield to maturities and an attitude that default rates will remain low forever. Well, they won't. The central banks cannot eliminate the business cycle. They'd like to think they will or have. Not true. We've seen this movie before. And then the only problem is that this time it's going to be aggrieved because a lot of daily liquidity products that are completely not be fit to own instruments like distressed debt. I know I'm not answering your question about Venezuela specifically. I don't know about that sovereign credit. Perhaps it's interesting, but I think that's going to be much more ensconced within the remit of someone that is sort of more legally minded and perhaps an investment firm that spends more of its resources in understanding international arbitration.
Hello, Michael. I have a question about future performance of two different portfolio strategies. Like, how do you see, for example, Azvalor current portfolio compared to UK's manager Terry Smith's quality at a reasonable price strategy? For example, in the next 5 years, because this person is not a value investor, he has done very well in the last 5 years.
Yeah.
Do you see that trend in the future, or maybe the time for a turnaround?
Well, firstly, just let me just say that I don't know Terry Smith well. I've been to a wedding where he was there, and I've met him when he was at first Colin Stewart, then Tullett Brebon, and so I've had meetings with him. And I worked once at a firm that was in the same floor as Fundsmith, so I saw him in the elevator from time to time. He's a really nice guy, and I have deep respect for him, and I love what he's done. And he's built his business very slowly. I think he's compounded more than 20% since inception. I think he ticks the boxes a lot in terms of delivering great Sharpe ratios, which is volatility adjusted returns. It's a metric a lot of allocators look at. And clearly he knows what he's doing, and he's probably figured something out and ahead of the game. So just on an ad hominem level, I think he's a fantastic person, the evidence is that he's a fantastic investor as well. In terms of his approach, the question mark is whether or not a quality at any price approach will work in the future. A lot of people have called the turn in value for years now. One of my slides talks about valuation dispersion. I thought when it kissed 2000 levels, we'd probably see a little bit of mean reversion, but we haven't. It's just the outperformance of high quality and low risks, low volatility stocks continues in earnest, and it may persist for a while longer. I think, I do think though that there's situations that we're involved in on a micro level where you have such enormous supply response that you don't even need the demand to work out to create an equilibrium, which will help support the companies. I'm thinking, here of uranium and energy stocks, for instance, to some extent coal. And so, because a lot of our investment theses are rooted in supply, not necessarily demand, I think that gives them a little bit more of a leg to stand on. So I think, I'm not sure whether they're going to say secular re-rating of value in a general sense, but I think that there's going to be a lot of opportunity in a micro sense, and that's really what we're focused on.
Thank you so much, Michael. The last question, what do you think about Boris Johnson?
About?
Boris Johnson.
Boris Johnson.
The new Prime Minister.
Boris Johnson. Oh, I thought Body Junction. That was an AIM company. No,
It's an easy question.
Gosh, I think we all have this sort of vision of Boris Johnson on a zip wire holding the UK flag, looking like a clown. I think he's obviously a lot more clever than he makes himself out to be. I think this kind of view of the bumbling charlatan is completely manufactured, and he sold it, and he's become a little bit of a darling for the media, because the media likes these unusual politicians that have very kind of interesting and differentiated populist streaks, as we've seen recently with Donald Trump as well. I think I have no doubt that he loves his country and he wants to do what's best for his country. I have to say though that I wasn't especially impressed with the way that he and some others, took down David Cameron's the Tory government and some of the games that were played. And there's evidence that Boris Johnson privately is more of a Europhile than he makes himself out to be publicly. And so, in that vein, I question whether or not his pronouncements are more to kind of appeal to the crowd and get elected rather than what he really thinks. And so, does that mean that he lacks integrity? No, not at all. I just think I would appreciate if he were a little bit more forthcoming on that side. I can't hide it. I actually think the Brexit decision is a bad decision, and it's bad because I'm afraid, I could be wrong, but I'm afraid it might lead to deindustrialization and job losses. So, why are they pushing this out? I don't know.
Bueno, thank you very much.
Thank you.
Gracias. Bueno, esta es la intervención de Michael Alsalem. Podéis reconocerle su intervención.